It's 6 o'clock in London. It's 1 p.m. in New York, 1 a.m. in Hong Kong, 3 a.m. in Sydney, 10 a.m. in San Francisco, and 10:30 at night in Mumbai. Greetings, good morning, good afternoon, and good evening, wherever you are in the world today. My name is Patrick L. Young. We are on to Series 17, Episode 1 of the IPO-VID live stream. In total, that makes episode 97. So, $250 million has already been written off by the ASX. No sooner did they do so over their failure to implement digital asset software for their, well, at one time viewed as revolutionary blockchain-based settlement system, replacing the old chess infrastructure. Now, the users have totted up their losses, trying to keep up with the ASX's failed innovation, and that number comes to $250 million. As the old saying goes, 250 million Australian dollars here, 250 million Australian dollars there. Sooner or later, we're going to be talking about real money. Meanwhile, as well as the ASX writing that off, the Johannesburg bourse finds itself in a remarkable conundrum, which really does leave us wondering whether we're in the 21st century. The South African state has failed to such a degree that they can no longer guarantee electricity for their citizens. I mean, this is South Africa we're talking about, full of energy. It's not Haiti or somewhere like that where they've got a near civil war going on. Nonetheless, the South African state has failed to such an extent that electricity is no longer being reliably provided. Thus, the JSE Group is, well, they have to be applauded. They're preempting the problem with a circa 1 week supply of diesel to power emergency generators as the South African grid collapses. What an incredible thing to be saying in the 21st century. Finally, something that is great news for the 21st century. We are delighted to see that our old friend, former European Nasdaq exchange supremo, Hans Ole Jochumsen, is joining the board of Euronext Clearing as an independent director. That's got to be a win-win for all parties. Great news from Hans Ole. Our guest today, ladies and gentlemen, is a fabulous and wonderful Professor Albert Menkveld. He's going to be discussing non-standard errors in markets. Albert Menkveld is Professor of Finance at the Vrije Universiteit of Amsterdam and a fellow at the Tinbergen Institute. He has taught, lectured, been involved with a multiplicity of great academic institutions around the world. In 2002, for example, he received a Tinbergen PhD from Erasmus University in Rotterdam. He's been on visiting positions for multiple years at various US schools, such as New York University, Wharton, and Stanford. Albert's research agenda is focused on securities trading, liquidity, asset pricing, and financial econometrics, and has been widely published in leading financial journals. For 3 years in a row, he's been the best publishing Dutch economist, according to the Economentop 40, published by the ESB in 2020, 2021, and 2022. So here he is on the crest of a wave, ladies and gentlemen. Albert, welcome to the show. Where in the world are you today?
I'm delighted to be there. I'm in Haarlem, Holland. This is my home office, and I broadcast often from here, classes and things like this.
Fantastic. It's wonderful to hear from you. I do believe you're the first person we've actually spoken to in this show in all 97 episodes who's been based in the Netherlands. So it's a delight to be breaking some new ground there. So tell me a little bit about your background. I mean, how did you get into academia? And in fact, how did you get into financial academia, Albert?
So I studied econometrics in Rotterdam, worked for a few years for the Dutch airline, KLM. So it was exciting at the time, this is late 90s, to work for a company like that and get to travel the world for basically 5% of airfares. But I grew a little bored intellectually. I mean, at the company, it was more of the same thing. And then I decided to go back to academia and study financial markets close up because I was really interested in, for example, for this company, KLM, it was trading both in Amsterdam and in New York, 50% of volume in both markets. And people were asking, like, which market really drives the value of this company? Is it Is it, you know, the hometown, Amsterdam, Euronext here, or is it really the New York Stock Exchange where all the world's largest companies are trading? So I grew fascinated by the question, and I started the PhD thesis zeroing in on that question.
Well, that actually is a very interesting question. I'm not sure, was there a resolved answer? I mean, there you are, you're in Amsterdam, probably the world's oldest organized bourse, and at the same, or at least certainly continuous organized bourse. And then you've also got the New York Stock Exchange, the powerhouse pretty much of the Western world's markets. What was the ultimate result? Who drove the stock price?
There's 1 hour and sometimes 2 hours due to daylight savings, where both markets are open at the same time, and that's really interesting because now you get to see like which exchange is pulling the price in the direction where it's going to stay. And broadly speaking, it differs across stocks, Dutch stocks. I forget which one actually is led from which exchange. It's been a long time ago. But it was interesting to see that it wasn't a one-size-fits-all for all these Dutch stocks. Shell, I remember, was mostly driven by Shell from the New York Stock Exchange. KLM also, but it didn't go for all the cross-listed Dutch stocks.
Well, it's certainly very interesting. I suppose the thing about Royal Dutch Shell is it was so distributed in terms of where it was actually involved in oil processes. I can understand how that was driven from America. I'm not trying to degrade in any way KLM, which is an incredible global airline and hits way above its weight pro rata, given the size of the Netherlands and population of the Netherlands. But it's fascinating to see how they're driven. In fact, we were discussing just a couple of shows ago about options markets, and it's very interesting to see today how European stocks, when it comes to their options, if they've got options in the USA, there certainly seems to be a lot of evidence that the volume and everything about the trading of those options is actually driven in the USA. And I think a good example there's the one I was talking about, which was Ferrari, where race options in the USA are super liquid and trading an enormous amount, whereas at Borsa Italiana, they're relatively illiquid. Fascinating. So you found this interesting driver of why was the share price running on different ways, and you were looking at that and you started investigating it. And so how did you then advance your career from doing a PhD to actually stepping into working in academia?
So at the time I was so the first few years I spent basically working at the airline. I struck a deal with them that I could work half of my time on my dissertation in Rotterdam at Erasmus. Half of the time I'd be fielding questions from analysts following KLM. And at the time it was the only stock that you could trade in the US, getting exposure to the European airline industry. KLM was the only one that was cross-listed at the NYC, which is why it generated the volume that it did, and probably why it was so leading in terms of price discovery, as we call it. So I became fascinated. I'm still working on this type of question today, and when you introspect and you find that what you get most excited about during the day. Since I was doing both jobs, it was really having the time to dive deep into more statistical econometric questions on how you would actually do that if you get prices and quantities traded in two exchanges. And these days you have not only multiple exchanges, you have all these off-exchange venues trading all of these securities. And so it's even more important today to get the right techniques or statistical models to detect which market is really responsible for what percentage of value discovery or price discovery. So your question was, how did I get from there to here? Well, I found that I was driven by that. I basically graduated from Erasmus, and then I spent some time in the US, educating myself further on frankly, the economics, because I think we're decent in Holland in terms of econometrics, statistics, but I was missing more in-depth knowledge on actual economics. I was doing auditing many courses at Stanford and at Wharton and at NYU, and then at the same time I was working on my research, and eventually after a few years, maybe almost a decade, I went back to Holland and I became full professor here at the Vrije Universiteit and I've been mostly doing research ever since.
Really very interesting, but it's also fascinating, as you say, how you can spend so much time studying economics in the US, where there is a remarkably strong body of research and discussion across not just the three universities you mentioned, but the whole system. And also, I mean, very interesting, because obviously you started your study at the very early age of electronic trading. Your doctorate, I mean, you then basically graduate before we have these newfangled and wonderful things like MiFID and so on. So you could see in the USA competition amongst equity platforms, but we didn't get the same sort of thing happening in Europe until already effectively the mid-2000s.
Right, and you might remember the first post-MiFID move was the LSE trying to get foot on the continent by introducing Eurosets. It's basically their system trading European securities. And the most friendly country to that second exchange really was Holland. People were here not too happy with the innovation of Euronext and the fees, et cetera, et cetera. And so the LSE tried it with Eurosets, and they allowed me to look into what happened when you had that second exchange trading Dutch securities, but now in the same time zone. And now you sort of see that I was very happy to get the data and actually study the way the market evolved.
Yes, and it's been an incredible evolution throughout the course of your career. And in fact, I think that's where we first met, was at one of the various FESE conventions where you've been speaking, the Federation of European Securities Exchanges. So, I mean, you spent this amazing decade in the USA. When you actually came back full time to live in Holland, it must have been fascinating how the markets had moved on and things were much more sophisticated than they'd been, say, when you started your PhD.
Well, sophisticated, I'd like to challenge.
Or complex, perhaps.
I'm not sure. Well, complex they've ever been. If you go back centuries, and I took delight in going through a book written by Joseph de la Vega, describing the details of how the exchange worked in the 17th century. And you get all this stuff. People were trading derivatives. There was speculation. There was some people were more informed than others. There was off-exchange trade. It was all that stuff. Yes, we've repackaged it, and you're right. To some extent, it's more complicated because the information technology made everything so much faster, and you could work at such larger scales. But you'd be surprised on how much of the markets remained the same in terms of fundamentals.
And I think you're absolutely right in the sense of mentioning that book, which I think is an absolute must read and has always been a must read in my view. Joseph de la Vega's Confusing the Confusiones. It's incredible. I mean, it's a stunning book. You're quite right. I mean, Amsterdam was trading all manner of derivatives. In fact, it was quite funny because Richard Sander, the father of financial futures, he and I have been joking about this for decades, because he would ring up in the 90s and say, oh, I was just, I went to the CBOT floor the other day and it's incredible. Go to page, 46. That guy that de la Vega is talking about, he's actually in the bond pit now. It's amazing. He must be 360 years old, but he still only looks sort of 25. And it's true, because, I mean, the dynamics certainly of the floor trading didn't change more or less throughout that period of time. But also, as you say, the product range was incredible, because we were actually doing road shows, the doc and I, promoting Life's single stock futures when they first came out in the late 90s. And it was great because everybody's talking about this whole new product, single stock futures. And we didn't want to point out to people too much, unless we were having a few drinks afterwards, that actually there's not a lot new under the sun. I mean, those single stock futures, you could buy them in Amsterdam 300 years ago, but just these days, they're a new thing. But it's very interesting, as you say, the complexity. One thing that always gets me is stock options, stock equities trading, because I come from the futures business originally, futures options and OTC derivatives, and it's just horribly complex. I mean, the process, you've only got two choices. You buy the share or sell the share. Okay, you can sell short, but it's essentially buy or sell. But yet the amount of complexity that seems to go into this processing drives me nuts. But that's just probably a whole other area of discussion. But your point's well made. I mean, there's nothing really that new under the sun in terms of the general area of product, the general area of process. It's just how it's been processed over time has changed. So what really drove your research when you started your professorship? Was it thanks to MiFID that you found sort of anomalies and you were interested? Was it due to exchanges coming and asking you questions? Some other form of intellectual curiosity?
No, you just mentioned the futures business, and that's where we interacted. I just looked up our interactions over the years. It was almost seven years ago when we first interacted over clearing, the fact that MiFID was coming in and the Europeans were taking regulation seriously for the entire continent made the structure of the infrastructure of the securities markets come into the limelight, and an important part of that infrastructure, also post the global financial crisis, is clearing. And I think that we did a few good iterations over the regulation there, and plain vanilla derivatives, being centrally cleared, I think is generally a good idea, but you need to understand that if you do that, if you bring all of the risk, counterparty risk, into a single entity, then it's not that your systemic risk is gone. It's basically consumed up by that single entity, and so you better take another look and a third look at the way risk is being managed there. And risk management. That's maybe it's going too far for this talk, but collateral must be lining up with the exposure that you as a clearing member create for the CCP, for the central clearer. But then you need to be able to measure that exposure really, really well. And there was one clearing agency here who was particularly interested in having me take an outside look in on the way they calculated margins, and that was the start of a few papers on clearing, which I still think is an under-researched topic and so important for the reliability of our entire infrastructure, really.
Totally agree with you. And I mean, the whole business of central counterparty clearing, where, by the way, I think the underlying providers do a remarkably good job. But yes, the sense of what you say, putting everything into one big bucket. I mean, my argument was always what I called the Homer Simpson supermodel buffet scenario, which was if you have an all-you-can-eat buffet and effectively you're next door to the elite model agency and all the supermodels turn up at lunchtime, that's great because you know that there's a very, very finite amount of food that all these young ladies are going to be eating because they all want to keep their figures. The difficulty is when you suddenly open that buffet up and you realize that on the other side of you, you've got Moe's Tavern and Homer Simpson's going to come in after he's had a couple of beers and his effective ability to eat food is essentially infinite, as is that of his friends. Suddenly you've got a very, very different set of risk parameters. You can understand now why I'm clearly not an academic like Albert, ladies and gentlemen, because I have no citations for what I've just discussed. But on the other hand, I think it breaks it down a little bit. So you're right. I mean, clearing has not really been given as much as it deserves. And actually, it was quite interesting, wasn't it? I mean, we were talking because all those 7 years ago, I mean, 2007, 2008 came as such a shock to so many people. And yet it was quite feasible when people write each other lots of IOUs that there could be a problem because we can actually see that from, well, I can name a couple of Dutch crises of several hundred years ago that would manage to help us there, let alone the rest of the world who've all had the same things. So you have, however, I mean, in recent times, you've been moving into this process. And it's very interesting. Break it down for me. I mean, the title of today's show, Non-Standard Errors in Markets. Explain to us where that comes from and what you were doing.
Yeah, so this is what we've been talking about so far. And that's where we intersect really. Interest on where markets are going, market infrastructures, and at some point, there was the econometrician in me woke up when thinking, after maybe 2 decades of research of maybe there's an uncertainty in the outcomes of all analysis we do, not only us academics, but also many of our listeners today who are quants in the industry. When you go about measuring a particular phenomenon you're interested in, let's say let's pick one important futures today, which is the Euro Stoxx 50 index futures. Suppose you want to, for the 2 decades that we're in now into the century, you want to see, with all the innovation that's been happening, and Eurex, quite frankly, is in the forefront in many ways of the way they've been innovating the markets. What is the outcome? What is the result of that? And what you'd like to do, for example, is see market efficiency. So what the trend of market efficiency was over the first 2 decades, or if bid-ask spreads, or more precisely, realized bid-ask spreads, have they improved over the years? Have they improved by 1% per year, like reduced by 1% per year, or 2% or 5%, or have they gone up? What happened to intermediation? If you have all these vehicles available to you as a trader, like algorithmic trading technologies, maybe you can work your large order through the market on your own using your algorithm, and you don't need the broker so much. So maybe intermediation has gone down and more people trade directly with one another. So what happened there? And those are the trends I think that we're all interested in, not only academics, but lots of people out there. But when you go about calculating that trend, you make all kinds of decisions. You have to first decide what, for example, what to include. Do you include rollover periods or no? What do you do with outliers? How do you clean up your data? What statistical model are you going to use? What part of the sample is really of interest? All those decisions, and we all know since you must come to one number, on all those forks in the road, you take left or right, and probably they're relatively unimportant individually. But you make so many decisions, which I experienced in my own research that we talked about just now, but others must experience as well. They accumulate. And so if you, Patrick, and I were doing the same analysis, and we were going through different paths, then it's of interest, like how much market efficiency. I might conclude that it's gone down by 4% per annum, and you might conclude it's gone down by 1%, or you maybe concluded that it gone up by 1%. And so we really want to know how large this dispersion is across analysis paths or across analysts when they do this, when they study the same empirical question. Now, that type of uncertainty I've been thinking about as non-standard error. So the fact that there's no standard path that we all agree on means that there is room for dispersion due to all of us taking a different path in the research trajectory. And the size of the dispersion that you get at the end of the path is of interest. And now, so that is conceptually what I've always been interested in. So we're very precise on standard errors, which is if you're interested in, as an econometrician, estimating a particular object, you get a finite sample, you can estimate it, and you get some error because the sample is finite, and that error is called the standard error. It's like a statistical error due to sampling error, essentially. Now, in addition, there is this non-standard error that creates uncertainty. Long story short, what we've been doing in the COVID period, really, where everybody was to some extent bored by another day at home and nothing happening, we decided to launch this project whereby we really do that. So let's make that data available to many research teams and see what they come up with, and that's what we did.
So okay, trying to get my head around this here for the simplicity of all of our viewers, and it's really fascinating. But it strikes me, So there are clearly standard errors which we can appreciate, but then we get into this area of non-standard errors, and that sounds to me a little bit like, I don't know if you've ever read The Hitchhiker's Guide to the Galaxy by Douglas Adams, where the philosophers threaten to go on strike, and one of their demands is the magnificent line, "We demand rigidly defined areas of doubt and uncertainty," which I think is possibly the greatest union demand of all time, and thoroughly mimics actually the Britain of the 1970s that it had obviously been based around. But it sort of, I'm trying to get my head around the idea that you have non-standard errors, but then is there a way that you can come up with a way to standardize non-standard errors, or are they already too derivative that it's impossible to get everyone on the same page?
So this is a great question. I think, and it's so the whole material is new to me and to many others, and I'm still trying to get my head around it. But it's worth thinking about these things. And so we ran that experiment. We had 164 teams the world over, high quality teams, because a third of the teams had people published at the very top. For example, many full professors and associate professors on board, people working in this area, and we gave them a data set that nobody's ever seen and nobody might ever get to see, which is 720 million trade records in Euro Stoxx 50 index futures, spanning 2002 to 2018. And for all of these records, you get to see who traded. So you get somebody taking the long side and the short side. But for both those sides to the trade, you get to see if it was an exchange member trading for their own pocket or for a client. So you really get at this notion of how much was intermediated versus done for clients. And if you talk about realized bid-ask spreads, you can decompose them into what was the realized bid-ask spread for clearing members and what was it for clients. And so they might be separate trends. So now to your question, like market efficiency is, let's take market efficiency. People measured it, and I brought two slides with me today. I'm trying to minimize slides because I think they're distractive, but these slides are sort of the core of the entire study. The first slide shows you for the 6 research questions, or researchers call them hypotheses, what the outcomes were across the 164 research teams who independently did that study. And people are all over the place. In terms of market efficiency, most conclude that it declined actually over the entire 2 decades, which is the leftmost column here. So that's research team hypothesis 1, efficiency. And this is the annual percentage numbers. So the median here, so these are box plots. So the boxes, they span 25% to 75%. And in the middle of the box is a horizontal line, that's the median. And the median was minus 1% per annum decline in market efficiency. And that's already sort of surprising with all that's changed. But what's more surprising is this huge dispersion where people are, the interquartile range is somewhere between plus a few percentage points to minus 10%. Now, your question is there a way to standardize? Could we sort of converge on a number that's more of a consensus number? And the way this works in academia, and to some extent, I believe outside of academia, is we get to see each other's outcomes and discuss them in conferences, at the water cooler, in the bar, etc. And then when you walk away from such a presentation, if I sit in a train back home or fly back home, I'm going to. What's going through my mind is all these questions people asked and suggestions they did, and I believe that some of these suggestions are actually better than what I did, or at least as good. And I'm thinking, like, out of all these suggestions, I might want to implement the first a few of them and improve my study. And this is what we emulated in this experiment. So not only did all of these teams do this, they did this in the first stage. The second stage, they got feedback from senior colleagues who read their reports, assessed their methodologies, and gave them constructive feedback. They did not have to implement it because they were co-author of the study no matter what. But if they believe they're reasonable, they could implement and re-report the estimate for market efficiency, for example, in the first hypothesis. And then we published in the third round what were the top-rated papers out of the 164 and showed them to everyone without showing the names. And in the final stage, they didn't have to code anything. They could just pick a number that ultimately, with all the information they had, was the truth on what market efficiency, in their view, the best estimator of market efficiency change. Now, what is there a way to standardize non-standard error? What we saw is a tremendous decline in the dispersion, like up to 50%, 50% across all of these stages. So all of this communication does get us to agree on a smaller range of outcomes. But what's interesting is we don't get to a single point. So that there's a persistent range, which I believe we should take account of in the report. As you know, depending on which angle point you take, which viewpoint you take, you're gonna end up. I'm just making this up now, but maybe you end up like -0.5% and -5% on market efficiency after all the review stages, all the peer feedback stages. Well, then that's important to know. So I believe that I truly believe that an outcome on all of these questions and research is a range rather than a single number.
So these numbers can be a range, not a single number. I suppose I would have to profess to being a market charlatan rather than a fine, splendid, rigorous academic such as yourself. But I mean, financial markets have this habit of finding solutions that are very crude, but nonetheless, they kind of work. And I suppose the best one of that is when they're looking at estimates of what people say are going to be the next series of statistics, whether it's, US unemployment, for example, on the first Friday of the month. And of course, the simple thing that somebody did there was took all of the different numbers that all of the banks came up with and all their different analysts and then said, okay, put them all together, average them all out, and we'll come out with a consensus average, which of course is fairly appalling if you're one of the particularly hard-working analysts who's come out with some outrageous, out of left field, possibly slightly beyond a sigma, beyond what everybody else thinks. But nonetheless, it provides a useful value. I suppose it's probably an appallingly sacrilegious thing to suggest to all of these rigorous academic teams around the world who are looking at this, but is it feasible to start thinking of the idea of taking these numbers and perhaps crunching together what all of the different people's results are and then saying, well, there's a kind of a central number, whether it's mode, mean, whatever, that gives us an indication?
I think it's nice that you draw this parallel, and I agree with you. It's still useful to have a single number, and maybe I would argue that the median is a very robust location estimator. It's least sensitive to outliers, so the median is a number that you'd want to see. Maybe if you have to put your if there's only space for one number in the headline, that's the number that you'd pick. But hey, wouldn't it be useful to know that, take two different cases where one was the median was a median in a distribution that was highly dispersed, where the first quartile was -25% market efficiency decline, and the third quartile was 25% market increase. Our market efficiency increase, being case one. Case two is it was -1%, but then the first quartile was -2%, and the third quartile was 0%. So I think these ranges are going to give you a sense of how much trust you need to put into that single number, or if there was a lot of uncertainty around it. So I would argue that maybe the median should be on the first page, but the line next, the subtitles should really have that range, because it's informative on knowing how much uncertainty or non-standard error entered that particular median.
That's very interesting. I mean, I'm just throwing these things out because obviously I'm a trader with a very short-term perspective on trying to understand things. So I'm always trying to get to the bottom of it rapidly. But okay, so you've done this study with this huge number of people. I mean, you're talking about they're studying 720 million trading records. You had 164 teams, so that got you what I mean, several hundred researchers, I suppose. What was the most interesting feedback you had from amongst the researchers themselves when they saw the whole of the research?
So that we did not tell them, obviously, to not color the outcome, what we were going to do. And in fact, we thought up the entire analysis so the paper in its original form was essentially carrying out whatever we thought up in the year before we started the experiment, and we put that in a safe. There is an open science foundation in California where you can put your plan in the safe so that you commit to doing that analysis. You minimize the degrees of freedom that you yourself might actually be enjoying when you want to, massage the analysis in a direction that confirms your priors or what you think that people would want to read. So to keep it really pure, you want to settle on what you want to analyze and put it in the safe and commit before you execute the experiment. So we did that. We did the experiment, then we wrote the paper. And people thought that we were going to report that median number that we just talked about. It was a crowdsourced study, and the first one in economics or finance, because it had been done in 2 years before in sociology, where people were asked to analyze a data set where the central hypothesis was a football referee was he more prone to give for the same type of foul a yellow or red card to a player of darker skin color. And so that was done there, and it created a huge amount of interest. And it was published, I believe, in Science, which is the very top journal in all of science. And since then, you see many of these multi-analyst studies appearing. So people were thinking that we would focus on the median, but the focus really wasn't on the median right from the beginning. It was on that range, on the uncertainty that you get when you ask different people to do essentially the same task. And so that was surprising to a lot of people, but that set them thinking. And one of the other things that came out was, as I said earlier, I was aware under which conditions I was working, and I was aware that I made these choices, and I was aware, therefore, that the outcome depended some on whether I took a left, center, or right decision each of the fork. But I had no idea on how these things would accumulate, and I would think that there would be relatively minor. And so we asked everybody also, before we gave them the feedback, like, what if you sit down and think, and you know that more people are doing this particular task, if you think and you about the dispersion that you'll see across all of those teams, and that was an incentivized research. So whoever got closest to the final realized dispersion got I forget, something like a coupon to buy something on Amazon in the amount of $100 or so. Okay. But we incentivized people to think about this. People reported that dispersion metric, and one of the most surprising findings to many was the actual dispersion was an order of magnitude larger than people's prediction of the dispersion. So all of us are relatively unaware of this tremendous difference in outcomes that you get when you ask people to honestly, to their own, to calling on their own honesty to estimate trends on markets, and quite frankly, this supersedes just academics, because, like you said, analysts write about earnings. The newspaper is full of analysis and charts, And I believe that there's a huge non-standard error on all of those. And this is just the beginning of it. I want to see how much the non-standard error is.
So, yeah, I mean, it's fascinating. So the non-standard errors are essentially all around us in every aspect of financial markets, however we look at it. And therefore, it's very difficult for me, unless I've misunderstood, to see any area of research or analysis where non-standard errors don't creep in remarkably quickly. Is that fair?
That's fair. That's absolutely fair.
Yeah. So therefore, yeah, go ahead.
No, the only thought that I wanted to add is when you've done all of this and you pause for a moment and think, like, what does all of this mean? And I think this is sort of what I'm reading into your mind when you ask this question, like, what does this all mean, and how should we go about doing research going forward? Because it's kind of expensive for everything that we're interested in. To drum up 164 teams or 350 researchers around the globe to do another study, and on the back of a piece of paper, I did a calculation that the amounts of resources that went into this project, with all of these people spending the time that they did, this was in some sense a giant parallel processor, with 164 CPUs. If you add up all of that time, you have an FTE of 27 academic years. So it's a full academic career that went into this project. Now we can't do this type of analysis for everything that's out there to study. But maybe we should think about it. If we all agree what the key questions are in whatever field of science we're in, maybe we agree on what those questions are, and for those subset of very important questions, we might want to, maybe not the 164, but at least maybe a dozen reputable researchers doing independently a study of the same data set, so that we get an estimate, not only the median, but also the non-standard error.
Okay, so therefore, in some ways, I'm listening here and I'm sort of thinking it sounds a bit like football. You're going to have a sort of a super league of researchers, and then you'll have a series of other leagues of researchers who might be doing papers, and it'll be quite interesting to see how they all come out. If we're looking at this whole process, though, is there a way over time, do you think, maybe not to come up with a sort of an ISDA master agreement of non-standard errors, but at least to reduce the number of ways people interpret or interpolate non-standard errors to try and get a slightly more homogeneous process?
I think that there should be lots of interaction. So academic conferences. I'm myself organizing the European Finance Association's conference this year in Amsterdam in August. But we'll have 2.5 days of almost 200 papers being presented, discussed. Then we have online seminar series. Then we have interactions like these. I remember we were sitting on a panel that you were chairing in Frankfurt, where we were talking about high frequency trading, the pros and cons. There was a high frequency trader on the panel. There was me as an academic on the panel, many others. These type of interactions also help me judge if my methodology of the way I measure things are accurate, or if they're incomplete in some sense, and adjust. And like I said, so the convergence is remarkable. And relative to all the other multi-analyst studies that have been done, none of them in none of the fields of science have tried to go at that stage 2, 3, and 4, where we measure that whether there's some sort of convergence in our estimates after interaction. So we should have more of that type of interaction.
Well, I think it's a great interaction. I'm only sorry, ladies and gentlemen, because of some internet problems, we've had to pre-record this show. So hopefully Flow will get their internet together one of these days and we'll be back to live streams. But I think it's very interesting what you say. I mean, it is great to have these interactions between practitioners and academics and so on. And certainly it's something that is a joy for economists in financial markets, as opposed to, say, historians, because it's quite difficult to dig up your subjects. But the interesting part I see is actually something we haven't discussed, which is the expansion of the core data. Because if we were sitting here having this conversation in 1994, let's say, when the internet was only a fledgling thing and there were various, I mean, actually, you could do the whole World Wide Web in a day in a subject area without any difficulty whatsoever. It's very interesting how in those days we still had floor traded markets, we had lots of bilateral markets. Actually, a lot of the trading data that you're talking about was frankly rubbish. I mean, the exchange data was very good, but anything that was coming from the OTC markets was pretty poor. But even the exchange data, they're really only capturing one or two things. I mean, they weren't even capturing bid and offers in the United States of America's futures markets, for example. They were just giving you the last trade and there was some element of volume related to it, etc., etc. Whereas now, of course, I mean, the world has moved on because, well, we've had the good folks at BMLL on a couple of times talking about their, 16 petabyte lake of data that they've got on equities around the world, and that's still expanding. So obviously the problem has grown, if only because the amount of data that you can suddenly play with has grown pretty inexorably during the course of certainly my career that's spanned all the way back to the late 1980s.
So what's interesting, that trend that you just identified with data sets expanding and more data becoming available, data of quality, I should say, becoming available for study by people like me, but frankly many others and many listening in today. To an econometrician, what this tells me is that with larger samples, you reduce standard errors. You have better ability, simply because the sample is larger, to estimate whatever object you're interested in learning about the data, bid-ask spreads or whatever you're interested in. So standard errors going forward become smaller and smaller. And so the trend really is, and I think this is the right moment in time to study these, is the non-standard error. That you don't necessarily, crash or reduce by making samples larger. That really doesn't. Larger samples don't get you smaller non-standard errors. It's really a different type of uncertainty in estimates that you can only tackle by measuring it and discussing what the different approaches are and what the more reasonable ones are.
That's very interesting. And certainly, I mean, it is a fascinating issue because it is just a growing pain of suddenly being able to capture all of this electronic data. And I suppose, therefore, I mean, I'm curious to know, what do you think is the next process? Because obviously you can't expect to keep doing studies, I suppose, that take up 27 academic years every time, because that is a...
Yes, so I think it's quite okay to keep doing. I'm not arguing that, and I agree, it's way too expensive to do all of these studies in a multi-analyst fashion, like multiple teams studying the same thing. It's quite okay for all of us to keep exploring research questions and hypotheses on data ourselves and write the reports about them. And I think in the evolution of knowledge on all of these dimensions, if a particular topic becomes important enough, maybe that's a time where we want to, or a trend becomes important or noticeable enough, where we want to involve multiple teams rather than a single one, to see what the where the community arrives at, what the median is and what the non-standard error really is. To see what's true about a particular trend, for example, and that's I think where this is gonna go to. But I'd be interested to look, if we have this conversation 10 years from now, what research will be like. But I'm convinced that it's going to be some elements of it. It's going to be multi-analyst type of research.
Certainly, it seems fascinating, the multi-analyst way as a way forward. And therefore, I suppose, though, I'm going to ask you our standard final question and offer you an opportunity to have a single analyst answer. Where, Albert Menkveld, do you think the capital market revolution goes next?
So this is, unfortunately, I can't involve all my 300 plus academics to get at this question. But when I think about these things, in the theme that we're covering today, we look at 10 years from now, what research is going to be like. We're not doing research anymore on our own little machines. It would be these MacBooks, etc. They'll be in the museum. There'll be clouds of with repositories of data, but along with those clouds will be code that analyze this data and then certified by different researchers, like that as the most appropriate way to go about analyzing a particular question. And then when you bring in new data, let's take the next years of trading. You don't have to sit down and redo the analysis. It's basically already there because you can run my algorithm or Patrick's algorithm or whoever other's algorithm to recompute what the market efficiency was in 2024 and 2025. And that certification and evaluation of that particular code is going to be something that's going to be indicative of how well established or accepted a particular type of algorithm is going to be. But let's try and have this conversation again 10 years from now and see if this prediction really came true.
December 7th, 2016, as fintech is being discussed at CE Impact here in Wrocław. December 7th, 2016, as fintech is being discussed at CE Impact here in Wrocław, a child is born. That child is going to live to be 130 years old. Their world is going to be unlike anything that we've ever seen before in history. They're born into an entirely digital world. When they get to reach the age of 18, they're probably not even going to have a driving license because they'll have a driverless car. They're going to have incredible opportunities through nanotechnology and biotechnology and the whole world of finance. The way that they deal with their pension going forward, even whether or not they actually use a bank, those are all going to be radically different throughout the course of their lives. Ladies and gentlemen, I'm terribly sorry about that. We are having problems with our Flow internet. That has been a marvelous show with Professor Albert Menkveld. Certainly when we get together to discuss this topic again, I hope it'll be sooner than 10 years time. We're going to be discussing something, Albert, but even if it's discussing what it is, well, all I can say is that by that stage, I hope that we've got better internet in order to discuss your single user studies, multi-user studies, and so on. This has been IPO-VID 97. I want to say a huge thank you to our guest, Albert Menkveld. We've been discussing non-standard errors in markets. Thank you also to our production team today, Fernando, Aracy, and Jamil. My name is Patrick L. Young. We're going to be back next week with episode 98, which will be at the same time and the same place in cyberspace. Thanks for watching, ladies and gentlemen. This has been IPO-VID 97. Have a great week in blockchain, life, and markets.